Danke. Meine Damen und Herren, Herr Dombret, Herr Otto, danke vielmals für die Einladung, um hier zu kommen am Bundesbank Symposium und hier auch eine Rede zu halten. Wenn Sie die Geschichte der Beziehungen zwischen den Niederlanden und Deutschland erholten, fürchte ich schon, dass Sie auch 1974 nennen würden. Aber glücklich, nachher kam 1988 und nachher noch ein paar Jahre, die nicht so gut gegangen sind. Entschuldigen Sie mich nur, wenn es zu wirtschaftlichen Themen kommt, dann ist es für mich ein bisschen leichter, um auf Englisch zu wechseln. Und so jetzt möchte ich gerne auf Englisch weitergehen. Und auch auf Englisch is it a great privilege here to speak to you at this Bundesbank Symposium, which I understand to be an annual tradition in the meantime. And this year it's actually on quite a topical theme. But before starting on that theme, let me first take a step back and just realize that if I would have told you 5 years ago that today, at this very symposium, we would spend half a day, no less than half a day here, on the theme of sustainability and climate risks, probably not only would none of you have believed me 5 years ago, but many of you would probably also have held me for a sort of tree hugger rather than a central banker that also carries some responsibility for supervision. And yet, here we are today. And this, I think, is a clear indication in the shift in thinking that has occurred both within the financial sector as well as in the supervisory community over the last few years. Sustainability has become more and more integral part of mainstream finance, evidenced by so many initiatives and so many examples worldwide. Of which, by the way, the Sustainable Finance Action Plan, which the European Commission is about to launch tomorrow, is only just the latest. At the Netherlands Bank, which is both the central bank and the supervisor of banks, pension funds, as well as insurance companies, we have been active on this theme for quite a number of years now. And I can imagine, though, that many of you might be wondering why we have been so active on this issue for a few years already. What happened there? Well, that is what I want to address today, here, in my speech From Mission to Supervision. First, how this issue got on our agenda, highlighting how and why sustainability is important for central banks, supervisors, as well as the financial industry. I will then turn to a thematic review of climate risks in the Dutch financial sector that we did in 2017, which led to a publicly available report called Waterproof. That will not surprise you, given that 3/4 of the Netherlands is below sea level. As Andreas has already explained to you how and why our economies and financial sectors could be impacted by climate change and the energy transition, I will not bore you by repeating that. Instead, I would like to share with you the outcome of our thematic review on the risks that we are seeing for the Dutch financial sector. And third, and finally, I will then say a few things on what this means for bank risk management as well as for supervision. All in the hope that we will walk away here with a better understanding of how sustainability can affect our different organizations. And hopefully also convinced that it makes perfect sense to incorporate sustainability into our day-to-day operations. So let me begin now by how sustainability got onto the agenda of DNB, and thereby also explaining in the process why this issue, I believe, fits the mandate of the central bank and the supervisor quite well. You see, not too long ago, sustainability to us just meant that we should ensure that our coffee cups were made out of sustainable paper and that the coffee in the cups was fair trade coffee. Sustainability was something we certainly thought it was important, but it was not something that concerned our core tasks, our strategy as an organization. Well, based on some of the smiles and the nods I see in the room, that we were not the only organization that thought in this manner. That changed in 2011, though, when the newly appointed board of DNB, which I was privileged to chair, concluded that it was an appropriate time to revisit its mandate. And when you revisit the mandate, you have to ask yourself the question, what is it that we are on earth for? What is our Existenzberechtigung? And I'm sure that is something that many of you have had to deal with as well, whether as a central bank or whether as a commercial bank. And mind you, this has happened just in 2011, coming out of the global financial crisis, but Europe was still in the midst of a sovereign debt crisis and emergency measures were taken all around us. It had become clear to us, but also I think to the many bankers and economists that we talked to, that a significant part of the economic prosperity that our societies had created in the early 2000s had been based on excessive leverage. Our economies had simply seen too much credit growth, which was not adequately backed up by underlying strong economic and financial fundamentals of corporates, households, and even governments. And all of these developments were in the back of our mind when we had to come up with that new mission statement for DNB. And one obvious implication of all of this being at the back of our mind that safeguarding financial stability needed to be a crucial part of this mission. Another implication was that we wanted to incorporate an element of the general good of the societies that we serve, contributing to increases in living standards and prosperity, again, of those that we serve. But there was something more relating to all these crisis developments that I just mentioned. Hadn't the crisis taught us that the prosperity we had created in the years before the financial crisis had proven to not be durable in the long run? Put differently, the prosperity had turned out not to be sustainable, because that's essentially what sustainability means, durable in the long run. And so, as we were walking down a foggy beach in Zandvoort, trying to come up with our new mission statement, we fortunately had the clarity of mind to add the word sustainable before the word prosperity. And our mission as a central bank and a supervisor thus became to safeguard financial stability and thus contribute to sustainable prosperity in the Netherlands. Now, of course, as we added the word sustainable to our mission, our main thinking was in relation to the economic and financial crisis. Sustainable prosperity meant, for example, that banks should have sufficient buffers to absorb unexpected losses. But it soon became clear that the word sustainable could have much broader implications. After all, if the way in which prosperity is created today results in significant ecological damage that prevents future generations from obtaining similar or higher levels of prosperity, today's prosperity creation is not sustainable. As such, it runs counter to our mission. Of course, formulating a mission is just the start. I'm sure all of you are well aware that any policy determined at the top of an institution needs to be embedded throughout all layers of the organization to be truly effective. And therefore, our policy became to incorporate relevant sustainability considerations in most of our core tasks. Of course, the extent to which sustainability can and should be incorporated depends on each of the individual tasks that a central bank or a supervisor may have. And I'm sure that the extent to which sustainability can and should be incorporated for financial institutions will not only depend on which type of institution you are, a bank, but possibly also a pension fund or insurance company. It may also differ per institution as well. For some of our own core tasks, it was quite practical. In our payment system task, for example, we are probably one of the only central banks in the world where 70% of our banknotes are now made out of either fair trade or organic cotton. And our goal is to reach 100% in 2019. For the other core tasks, it was more conceptual and more theoretical. As part of our economic research and advisory function in the Netherlands, we published an exploratory study called Time for Transition. In it, we identified the upcoming energy transition as agreed upon by more than 190 countries in the Paris Agreement in December 2015. And we identified that as one of the economy's key long-term structural challenges. In the report, we urged the government to pursue a plausible and practicable path towards a carbon-neutral economy, as such a long-term view enables households and businesses to gradually adjust their investments, preventing excessive misallocation. And we also decided to take a closer look into climate-related risks for the Dutch financial sector as a part of our supervisory mandate. Which takes me to the second part of my speech here today. What are the risks that we see as a supervisor on the Dutch financial sector? In 2017, as I mentioned, we concluded a thematic review on this issue. And in this review, we took a deep dive into 4 topics. First, climate-related damages for the insurance industry. Second, risk for the financial sector from a potential flood. Third, risks from the financing of carbon-intensive assets, so-called brown finance. And last, risks from the financing of assets and projects that are meant to contribute to the energy transition, the so-called green finance. Today I want to share with you some key findings for banks regarding the risks of both brown and green finance. In terms of brown finance, one of the things that we wanted to do was to get an understanding of the size of the risk. How big of a risk is the energy transition for our banking sector? As a first step, we wanted to measure how exposed our financial industry is to sectors that need significant reforms to become carbon neutral. Sectors such as fossil fuel producers, the utilities industry, the heavy industry, agriculture and transportation. Coincidentally, sectors in which the Dutch economy is quite significant also in terms of its sectoral composition. This wasn't something that we could easily get from our supervisory data, which is why we welcome the work of the European Commission on developing a taxonomy for the sustainability of financial assets as part of this Sustainable Finance Action Plan. For our research, however, we had to develop our own template to our financial sector to fill out. We sent this template to the 3 biggest banks that are covering around 70 to 80% of the market. And what we found is that banks' balance sheet consists of around 11% of exposures to carbon-intensive industries. Not surprisingly, most of these exposures are to traditional loans, which makes banks less sensitive to market fluctuations than, for instance, insurance funds or pension funds. Moreover, most of these loans have a maturity of less than 5 years, which should provide the banks with sufficient scope to anticipate changes, especially if the transition is relatively gradual in nature. In one area, however, we already see transition risks materializing, and that is in the real estate sector. The real estate sector plays an important role in carbon emissions in the Netherlands, and it's therefore also quite sensitive to the energy transition. In the EU, many, if not all, residential and commercial real estate have energy efficiency labels ranging from A to G, with G being the least energy efficient building. The Dutch government has announced legislation that by 2023 it requires almost all offices in the Netherlands to have a minimum energy efficiency label of C. So only A, B or C. Any office that doesn't meet that requirement can no longer be used. And this affects the banks, of course, in 2 ways. First, through the loans to regular corporations who use their own offices as collateral for the bank loans. And second, through loans to commercial real estate developers that lease offices as a business model. If some of these offices may no longer be used or will need to be upgraded to meet the requirement, this could affect the value of the collateral or the ability of the commercial real estate company to pay back their loans. So how big an issue is this for our banks? Unfortunately, neither we nor our banks know the energy label distribution of the offices used as collateral for loans to regular corporations. For loans to commercial real estate companies, the second channel that I identified, banks know of roughly 50% of those loans what the energy label distribution is. Of those loans where we did know the label distribution, we found that 46% of the bank loans to commercial real estate companies in relation to these offices have an energy efficient label lower than C. And that constitutes around 6 billion worth of loans. Not an insignificant amount, given also the limited scope of observation that we have thus far. All these loans, one could say, have elevated credit risks, which the banks, one way or the other, will have to manage. Fortunately, we're also seeing many banks react quite swiftly. Banks are now demanding that any new loan or refinancing of existing loans in relation to those offices is dependent on the client meeting the energy label requirement on time. And this should ensure that banks will have limited exposure to offices that won't meet the deadline on time. For us, this national legislation is a prime example of how the energy transition will lead to risks in the financial sector. And I think there is some similarity with the example that Andreas also gave on the German car industry, on which, of course, I'm much less knowledgeable than Andreas, but I think the mechanism here is quite similar. Well, we didn't only look at the risk of brown finance, as I indicated, we also looked at the emerging risks of green finance. First, there is, of course, always the risk of a green risk bubble emerging. History shows us that many transitions are accompanied by a boom-bust cycle, whether it's the dot-com bubble in the early 2000s or the railway mania of the late 1900s. Whenever there is increasing demand, a hype, or new market opportunities and instruments, there's always the risk of a bubble being created. And while we are still far away from a green bubble, in my view, institutions do tell us that green projects have become more and more expensive, as competition has increased with more and more institutions essentially bidding for the same limited amount of projects. A second risk that we see is what we call greenwashing. Do investors and consumers really know what green is when they think they are buying green? There are examples of a green bond being issued to make a coal plant more sustainable. In and of itself, there's nothing wrong with making a coal plant more sustainable, or at least it's not for me to decide whether it is wrong. But what is important is that purchasers of such bonds should be aware of what they actually buy. And here too, I think the work of the European Commission on a sustainable taxonomy, as well as on the standards for green bonds, will be most welcome. Lastly, we are seeing an increased lobbying effort to lower capital requirements to stimulate green investments. Andreas has already touched upon this, so I won't repeat that, other than to say that I wholeheartedly agree with him. Capital requirements should remain risk-based. We are thus quite skeptical of the expected plans of the Commission in relation to the prudential requirements, even though the Commission also acknowledges the principle that capital requirements should always remain risk-based. So let me end with what this all means for bank risk management and bank supervision. The main conclusion is that banks, including those presented here today, will need to manage material climate-related risks, and that supervisors will have to supervise this process. This is, of course, easier said than done. If anyone in this room already knows how to exactly manage these climate-related risks, well, please join us at the podium in a minute, I would say. But in my view, at least two things are important to keep in mind here. One is that incorporating climate risks is greatly facilitated when governments impose clear and long-term transition legislation, which gives banks the ability to steer toward a set of well-defined goals. And this is exactly what we saw with the energy efficiency requirement of Dutch offices. Second, for many parts of our economies, unfortunately, there is not yet that clear legislation that would allow banks to anticipate such a set of well-defined goals. In those cases, the banks would still do well to try and gauge how their business models and which part of their balance sheets would be most strongly affected by the transition, and which type of legislation or technological change might be expected in those sectors. It would then be prudent to try to assess potential losses as a result. Scenario analysis and stress testing would be a good tool for this, and this is actually what we are also working on. Put differently, institutions will need to take a more forward-looking approach to incorporate climate-related risks. This process can fortunately be helped by implementing, for instance, the recommendations that the Financial Stability Board Task Force on Climate-Related Financial Disclosures has made. Implementing such recommendations means that you will need to explain the governance, the risk management, and the strategy on climate-related issues. And you will need to explain which metrics and which targets you use to prepare yourself on these issues. And all of this, of course, means that you need to have such a strategy, risk management, and government system on the issue and the subsequent metrics to measure the progress in these areas. Fortunately, we are seeing many financial institutions in the Netherlands and abroad experimenting with incorporating climate risk management. One Dutch bank, for example, has incorporated the energy transition into its credit policies for loans to the utility industry. And this bank will only finance utilities that have carbon reduction strategies. And the bank wants the average energy mix of the utility companies it finances to be in line with the 2°+ scenarios from the International Energy Agency. And this is precisely the kind of thinking and attitude we need to start incorporating climate risks considerations into investment decisions. It won't be easy, and I'm sure it won't be perfect at first either, but we need to get started somewhere. How to precisely incorporate climate-related risks into banking supervision also remains an open question. Here too, essentially, the same 2 points stand out. One, when risks are already material, we can of course try to assess them. If Dutch banks, for example, were ignoring increased credit risks from the sustainability requirement for offices, you can be sure that we would be in a serious supervisory dialogue as part of the Pillar 2 credit risk assessment. But that's of course just one very specific example where there is a specific transition legislation affecting only a small part of the economy and a small part of the bank's balance sheet. It's much more challenging for the energy transition as a whole and for banks' balance sheets as a whole. How should supervisors assess how well banks are incorporating climate-related risks there? Do we need to establish a separate risk category in the supervisory review and evaluation process, as some members of the European Parliament have recently proposed? Or can and should we just incorporate it into the existing SREP elements, such as, for example, credit or market or operational risks? Well, we don't have all the answers yet, but we will continue to explore these questions in the years to come. And of course, we hope that you will join us in doing so. One thing should be clear, though: sustainability factors and climate issues in particular can affect the solidity of financial institutions and therefore warrant the consideration of banks and supervisors alike. Fortunately, just a few months ago, central banks and supervisors from 8 jurisdictions, including Germany and the Netherlands, launched the Central Bank and Supervisory Network for the Greening of the Financial Sector, also already referred to by Andreas. And this network aims to enhance the role of the financial system to manage such risks and to mobilize capital in the transition to an environmentally more sustainable world. My colleague, Frank Elderson, who was recently elected as the first chair of this network, and is very eager to take this work forward. I'm grateful and excited that the Nederlandsche Bank and the Bundesbank will work together in this network to advance the issue within the international supervisory community. So, ladies and gentlemen, today we went from mission to supervision. I hope that the transition that DNB underwent as an organization, where relevant sustainability considerations have been incorporated into our core tasks, has inspired you, or better still, even sounded familiar to you. But I can also imagine that some of you might still remain skeptical as to the appropriateness of all this. For those, I'd like to end by sharing something that my colleague Jan Sijbrand said to me recently. Klaas, when it comes to sustainability, we are being criticized from both sides. There are those who say that we are operating beyond the boundaries of our mandate. But there are also those that are saying that we are doing way too little. To me, he said, that's a clear sign that we are exactly on the track that we should be. And with that, I'd like to conclude it for now, and I thank you for your attention.